Thanks for inviting me. Thanks for the stage here. I mean, I've got a great bunch of co-panelists, but my name's Joe Saluzzi. I'm an institutional trader. I co-own a firm called Themis Trading. We're located in Chatham, New Jersey, so we're not on Wall Street. It doesn't really matter nowadays. You can be anywhere you want. We've owned the firm for 10 years. It's a small institutional broker firm, like I mentioned. We trade for mutual funds, hedge funds. A mutual fund could be a multi-billion-dollar fund, a hedge fund, say a $100 million fund. Agency only, no prop trading, okay? No market making, no research, nothing, straight execution. So what you're getting from me is the point of view from a practitioner who's working on behalf of an institution. We've felt very strongly about certain topics. In fact, we wrote a book, okay? We have a book out called Broken Markets, and I do have a slide somewhere. Maybe we can put the slide up. Before we name that, we're going to call the book The Monster Under the Stock Market, but we decided against it. What you're looking at right there is the story I'm going to tell you. That's the U.S. stock market. Looks good, right? You think anybody would have ever envisioned setting up a chart like that? Maybe a madman? Maybe somebody in an asylum somewhere? Why would a stock exchange look like that? Why would the United States equity market look like that? Well, I'll tell you a quick story, and I'll tell you how we got there, and then maybe I'll tell you some suggestions that we have to kind of, fix that mess a little bit. In 1994, there was a study by Christie Schultz. They found that market makers were colluding in the over-the-counter market to keep spreads artificially wide. It was an odd eighth study. The SEC was lax. They missed it. 2 professors found it. Surprise. Okay? The SEC had to act, and they had to act quickly because the public was screaming that there's collusion going on in the market. The SEC embarked on 15 years of regulation. 15 years, starting with the order handling rules in 1997. The order handling rules were the start, and I won't go through all the gory detail. Read the book. I'm not selling books. After that, Reg ATS. Prior to my career at Themis Trading, starting it, I worked at Instinet for 10 years. Instinet was the first electronic trading broker, institutional network. That's what it stood for. Right? Our job was to help institutions like Ryan's execute their trades without the leakage and slippage going on. Reg ATS changed all that, created a whole new class of destination called an ECN, an electronic communication network. That created a firm called Island, which was actually a derivation of a firm called Daytech, which was essentially a bunch of guys who used the technique of SOs to get ahead of other investors. So Island, and I'll tell you more about them later. But after Reg ATS, we decided it wasn't enough. At the time, chairman was Arthur Levitt. He said, let's do decimals. Who prices stocks in eighths? What are we, archaic? Great idea, decimals. Yeah, we're all for it. Except they forgot about a minimum increment. Every stock is allowed to trade at a penny-wide spread, regardless of the size of the stock. You could be a $100 million company. You can be a $500 billion company like Apple, $600 billion, whatever they are nowadays. So that's another situation. So you've now gone to decimals. After decimalization, things changed a lot for the exchanges. And the exchanges said, this isn't really working. We're going to change our model from a mutually owned member organization to a demutual, for-profit, and in two cases now in the U.S., public. 2 exchanges are publicly owned, in New York and NASDAQ. Changes things again. Now, what used to be a quasi-utility function has now become a for-profit entity with different interests at heart, obviously their bottom line. After demutualization, we're coming up to the granddaddy of them all, Reg NMS. The geniuses created Reg NMS. And now when I say geniuses, they actually did have lots of problems. And they tried to address it with a massive regulation. But that was the problem. When there's massive regulation, there's also massive unintended consequences. And that created that chart. The point of competition with Reg NMS created all of this, created all of these entities now trading on behalf of separate destinations, which were linked together by Regulation NMS, which said that you have to trade with the top of book. Reg NMS said, if you're the best bid and you're the best offer, I can't sweep that offer until I have to clear the top of the book to buy. So even if it was 100 shares, I can't get below it until I clear that 100 shares. Reg NMS created timing differences. Here's where speed comes into play. If you look in the chart, of course, in this chart we created tongue-in-cheek, of course. Okay? Actually, my partner Sal Arnott created it and actually just scribbled a few things in, and a couple of firms actually had problems with us putting their name on it. But that's a different story. But what holds that chart together is the glue of HFT, right? And Remco will tell you this. I mean, they can trade amongst many different destinations, and they trade very quickly, and that's fine. But what happened was, during the way, the traditional market makers said, this isn't working. I can't make money off of a spread, which is a penny, first of all, and my trading department, which used to fund other departments, whether it's research or, you know, banking and whatnot, it wasn't working. So what you found was a lot of small to mid-sized brokers, at least in the US, have gone out of business. Names like Robinson Humphrey, McDonald and Company, all these old names I can bring up to you, which were mid-sized bankers who came out with mid-sized and small-sized IPOs and would support these IPOs, are now gone, all out of business. And they've been taken over. Obviously, there's still the big brokers who are around, which leads us to a crisis in IPOs, and maybe we can get to that later. The problems now, and so that's where we are. Okay, that's what it looks like. And by the way, we're exporting that around the world. Would anybody like it? Come take it. Maybe the Indian regulators want to take a look at that. That's the lovely chart, right? Anyway, what we got now is, the way we look at it is we got three main problems with this chart. Maker-taker, which you guys have all heard about, and we've talked about it, which is the rebate model. Okay, we call it a payment for order flow model. The exchanges will pay me as broker to add liquidity to their system. I'm a small broker, so I get maybe 0.2 of a penny. If I take liquidity, it costs me 0.3 of a penny. Difference is the spread, and that's what the exchanges make. Our opinion is that the rebates are distorting flow, are creating situations, what we call rebate arbitrage, where if you are faster than someone else, you can essentially trade a stock, flat P&L, and still make money. Buy it at 7, sell it at 7, collect a rebate, you made a third of a penny on each way. There are tiered rebate systems. The bigger clients get better rebates, they pay lower take fees, and so on. This creates a conflict of interest in there, number one. Number two, proprietary data feeds. Every exchange has a proprietary data feed that they can supply to your clients. Anyone can buy it, or I think it's still in the US, it's free. In itself, it sounds like a good idea because you can create this fast thing. Well, not everybody's buying proprietary data feeds. Not everybody's subscribing to them. Now it's available. I can take advantage of it, and I do use systems that have access to these proprietary data feeds. But the problem is that, at least in the US, and you guys don't probably have this problem in Europe yet, we have something called a SIP, which is a security information processor. It consolidates all of the quotes. So you would think that's a great idea. Just like a consolidated tape is a great idea, and we have that too, and we still have issues, but whatever. Anyway, the SIP is slower than if I created a proprietary feed quote by myself. So if an HFT firm has access to that technology and wants to spend the money, co-locate the computers, they can create the quote faster than someone else. They can see that quote faster than somebody who's reading the SIP. The problem is, most dark pools, even now, are still pricing off of the SIP. So a dark pool quote may be a bit stale, and it could be arbitrage. So we consider that something called latency arbitrage, which is now in the system. And finally, if you really want to spin your head one day, and you really have nothing to do, like I do sometimes, look at the exchanges, and I'm sorry, Mark, but I look at the order types for some of the exchanges, and they get really crazy in the US. And there's all different types of orders that will give you an advantage, let's just say. Will put you to the top of the book. New York, the NYSE ARCA just created one of the best ones, I thought. It's called the ARCA Select PL. And what it does is, you can place an order, and that order will not interact if the other side is bigger than you, if it's an ISO order, which is an intermarket sweep order, or if it's an IOC, immediate or cancel. So you are determining which orders you now want to interact with. Sounds contrary to Reg NMS, in my opinion. But these order types have now seeped into this, they're in the system, okay? Rebates are in the system, direct feeds are in the system, and who's watching? Well, that's supposed to be the SEC. The SEC is supposed to say, no, that's not a good order type, it doesn't. Here's the thing. The SEC's mandate is when there's a question whether or not it's a short-term or long-term investor's interest, who can get hurt, you always side with the long-term interest. That's their mandate. We don't think they've fulfilled their mandate. That's why we call this the Frankenstein monster that the SEC created. And now they really don't know what to do about it. So they've tinkered around the edges. They've put circuit breakers in. They put naked sponsored access. They got rid of that. Stub quotes. You've heard all these terms in the US. And to us, it's still not addressing the main issue of what's wrong with the market. And it's that type of system which has kind of taken away the responsibilities of the traditional market maker. I know a lot of guys, and Ryan was saying, back in the day of the specialists, there were lots of problems. People scrim. Hey, when I was in Instinet, we fought the specialists all the time. You know, we were trying to trade their stocks as well. New York had a lock on it. But the specialist had an obligation. Whether or not that was enforced is a different story. The specialist had affirmative and negative obligations. The specialist was not allowed to front run. Going back to the point of front running is illegal. Okay, it is illegal when you have a customer order on your desk. However, if you're a market maker and you're a proprietary trader, you're not front running, are you? You don't have any client orders. Why would this is not an illegal thing? So we're in the gray area here. Lastly, I'll just get to the notion of spreads. And I know we saw some charts on spreads, and I appreciate those. The way we saw a chart by a firm called Richard Garlick, RGM Advisors, who put one out in the States, and it was an HFT firm, and he basically said that we've saved $0.015 on spreads over the last 6 years. And we said, well, $0.015, if you went from 3.5 down to 2 cents on the Russell 1000, is that really enough to compensate the risk that's been put into the system? Is it really enough to compensate the cost that now has to be borne by the regulators, as someone mentioned before, and by the people who have to now fight and compete in the arms race? And then going back to the spread, one other point, is a spread really a meaningful notion anymore? Does it really matter if the spread is a penny when there's really not a quote there? Right? A quote in the olden days, right, when there were specialists with guys, and by the way, if you look on CNBC and you see those guys running around the floor, that's not where the stock exchange is anymore. It's in Mahwah, New Jersey. Okay, come see it. It's a big warehouse. Okay, but the spread is a meaningless notion in our opinion because there's no quote. There's no one that says, I'm quarter bid for 5,000. I'm 5,000 off at a half. It was a wide spread, but still that was a quote. And then if you went down to the floor, they should honor that quote. And if they backed away, well, then you're looking at somebody face to face and you're saying, you just had a quote out there. It's more policeable. There's more self-policing going on. The system has obviously changed. We're not anti-technology. If you look at my desk, it looks exactly like any other trading desk on Wall Street. Bloomberg trading system, all sorts of technology. We don't want to go backwards, to the 1980s. However, maybe a little bit before this mess started may be a good idea.